Today we're going to discuss Tesla's Q1 earnings. We'll also talk about a major issue with their new Cybertruck, and we'll also discuss valuation because there is a lot of polarity between analysts on where this company should actually be valued. So if you enjoy the video, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. I want to start off by talking about Tesla's stock performance because here on Friday, the stock moved down about 2%, and it gets worse the further out we go. Over the last 5 days, down almost 14%. Over the last month, down about 14%. And year to date, Tesla is down an incredible 41%. And that's despite the fact that the market has had a very positive start to the year. The S&P 500 is up about 5% year to date. Google has put up gains of almost 12% year to date. Amazon is up a very solid 16.5% so far this year. And even Ford Motor Company has traded basically sideways so far this year. Over the course of the last 5 years, Tesla has put up an incredible 800% return. However, when you go out just 4 years, the stock has basically traded sideways. And overall, Tesla has experienced a number of short-term as well as long-term issues that have scared off investors. In the short term, there was a recall around the Cybertruck over a faulty pedal that was getting stuck in the acceleration position. This is concerning for investors because you never know how much this is going to cost the company to go back and fix some of these issues. The good thing is there hasn't been a major rollout yet of Cybertrucks, only around 4,000 so far on the road. However, this could be a bigger problem if they can't get these things right over time. The bigger issue for investors is all of the price cuts that Tesla is doing across the globe. In China, Germany, and the US, they have looked at their pricing and reduced some of the prices of their vehicles. This is a big concern for investors because margins have always been something that Tesla has prided themselves on, and that has led to a very strong balance sheet for the company. However, when we start seeing Tesla cut their prices, this is a concern of whether the company will stay above these other motor companies like the Fords of the world, and if they are more falling down the trap of having to reduce their prices to stay competitive with all these other car companies. Some of these cuts include a $2,000 price reduction on their Model Y, Model X, and Model S, as well as a reduction in price from $12,000 to $8,000 on their full self-driving software. In my opinion, I don't actually think this is a Tesla problem. I think it's a macroeconomic problem. With interest rates being so high, any larger purchases for consumers are going to be difficult because they're going to be paying so much more in interest. And that is something that Tesla is cognizant of, and they want to stay competitive and get more of their cars out on the road, so they're looking to reduce some of their prices to offset some of those interest costs for consumers, which overall I think will be a good thing in the long term. However, in the short term, this could hurt their earnings. We can see the last 2 quarters they have missed on both their EPS and revenue numbers, and they're set to report their next quarter on April 23rd. And analysts have an EPS estimate of 50 cents and a revenue estimate of $22.3 billion. And on Yahoo Finance, you can get a range of estimates, and currently the average EPS estimate is 51 cents. There is a low estimate of 20 cents and a high EPS estimate for this quarter of 87 cents. Year over year, they put up 85 cents a year ago, so the average estimate is a slight drop in EPS over the course of the past year. And there's a lot of concern going into this earnings report as Tesla has missed their numbers in their last 2 quarters by 8.3% and 4.1%. And this has led to analysts actually dropping their earnings estimates. 90 days ago, analysts had an average EPS estimate of 79 cents. That has since dropped all the way down to that 51 cent number we just talked about. And we've also seen massive volatility in their current year 2024 EPS estimates as well as their 2025 estimates, which is crazy because we are seeing a $1 drop in their 2024 estimates from $3.74 90 days ago down to $2.67 currently. And there has been an over $1 drop on their 2025 numbers, $4.90 90 days days ago and now sitting at $3.62. And not only are there concerns over the last 90 days, but when we look at the ranges for their 2024 and 2025 numbers, they are huge. In 2024, the low EPS estimate is $1.12, with a high EPS estimate of $3.63. In 2025, those numbers go up to $1.43 on the low end and a high EPS estimate of $6.84. And overall, when you see a range that is this massive, it shows two very polarizing groups of people. There are the bears against Tesla that are putting up these very low EPS estimates because they're expecting this pull down in demand, and you have these bulls who are expecting an increase in demand, increase in margins, and better pricing of vehicles. And overall, who's to say who is going to be right at the end of the day? However, this could present a very good opportunity to get into a stock like Tesla if it were to drop even lower, because these prices are absolutely insane because of how much volatility there is on the EPS estimates. And when I talk about prices, I'm really talking about their valuation. Their trailing PE ratio is currently sitting at a 34.19. However, their forward PE ratio is sitting at a 49.75. But when we look at these valuation metrics, you need to keep in mind the EPS estimates that are behind them. And these numbers can get kind of insane with the range as wide as it is. When we're talking about 2024, if Tesla were to put up $1.12 of EPS, that would mean they're trading at a forward PE ratio of 131. However, if they put up the high end of EPS, $3.63, their forward PE would drop all the way down to a 40.5. And these numbers continue to be insane in 2025, with $1.43 resulting in a forward PE ratio of 102.8. However, the high EPS estimate of $6.84 results in a PE ratio of 21.49. Personally, I wouldn't mind if Tesla puts up some very questionable numbers this quarter. I would love to see this stock drop below that $120 mark like we saw back in January of 2023. If we were to see Tesla drop down to $115, I would be a lot more interested in the company because you build in a little bit more margin of safety with these numbers. You're now talking about an average PE ratio of around a 43.07 for this year's earnings, and next year's earnings 31.77, which I think is a fair value for Tesla. And if they outperform next year and maybe we see interest rates drop and more people are out buying cars, you would be talking about a forward P ratio of just under 17. It's hard to say what type of numbers Tesla is going to put up in this next report. However, if I had to bet on it, I think they would miss on their top and bottom line numbers. And I really actually hope that they do, because I think this could send the stock down into that $100 to $120 range that I would potentially be a buyer in. I've never actually owned shares of Tesla, but I've always wanted to, and I think it's a great company for the long term. They're just going through a very tough period with these higher interest rates that we're experiencing right now. But keep in mind, do not buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, one of my personal favorite dad jokes: you have cheese but no crackers. What are you? Thanks for watching.